Assalamualaikum everyone. The topic on hand today is the liquidity of the market with focus on the resilience. I'm going to discuss a few true and false statements with you focused on the resilience part. So understand the market liquidity resilience. That is the capacity of the liquidity to absorb shocks of US treasuries is crucial from a financial stability standpoint. Yes, that's true. Understanding the financial stability is important, and it's important with regards to shocks. So this is definitely important. Second, impaired market liquidity makes security trading more difficult by increasing funding costs. This is again a true statement. If your liquidity is impaired, then trading will become impaired because the transaction cost will increase. The third one, the concept of liquidity resilience is linked with the ability of the market to withstand shocks. This is incorrect. It's linked with the in not with the inability, but with the ability of the market. The more resilient the market, the more it has the ability to withstand shocks. Okay, fourth statement. In a non-resilient market, a state of high liquidity can suddenly transform into one of low liquidity in response to a shock. The statement is true. Since the market is non-resilient, it can easily switch from high liquidity to low liquidity and back again. So this statement is true. Fifth question. Although low liquidity is a leading indicator of low liquidity resilience. Uh, if a market is resilient, then the liquidity would tend to be lower. However, high liquidity levels can support the illusion that the market is resilient and induce more risk taking. This statement is true. Even though higher liquidity does tend to be associated with higher resilience, but in an non-resilient market, if the liquidity is high, it can also give the illusion that the market is liquid. So you have to be careful in understanding the market from more than one perspective to understand if it's resilient or not, just not based on the liquidity that you see. Okay, the next question, sixth one. The conventional liquidity resilience measure is the speed of recovery of liquidity after one shock. The statement is true. This is the definition of resilience of the market, the speed at which it comes back to its true position. Eighth statement, episodes of sudden unforeseen loss of liquidity are a source of fragility. So when the equity of the treasury markets, there is a loss of liquidity because of structural changes, how the spreads change. Yes, if there's a loss of liquidity, then structure because of some structural changes, then the resilience of that market has decreased during this time and the market becomes fragile. The statement is precisely true. Ninth statement, financial markets have been affected by a number of structural changes over the past few years. Yes, we have seen the crisis of 2008, which was followed by inflation, hyperinflation in some countries. Again, we are facing the debt crisis, the insolvency issues, the Silicon Valley bank crisis. These things are structurally integrated into the financial markets at the time. Innovation has generated a broad trend towards fast electronic trading. and necessary regulation implementation in response to the global financial crisis has discouraged them from market making as a principle. These developments, alongside occasional bursts of volatility associated with short term illiquidity, have led to concern of market liquidity may become more fragile. Yes, the statement is true. Electronic trading in itself is very good for resilience. This increases resilience of the market. Necessary regulation again increases the resilience of the market. But these two things did not happen alone. They happened with a number of structural changes, a financial crisis, and because of this occasional bursts of volatility, then we also had periods of short-term illiquidity. All of these two things together indicate that the resilience of the market has gone down. So yes, this is definitely a true statement. The resilience of the financial markets have gone down, even though the steps individually, like electronic trading and necessary regulation, were supposed to increase the resilience of the market. Finally, one of the common goals of Basel, the prudential regulation, and the State Bank of Pakistan is to increase the resilience of the market. This is true. Basel's prudential regulation and State Bank of Pakistan are focused on improving the banking sector of Pakistan in such a way that it is able to absorb losses. So their aim is to increase the resilience. Thank you for watching. Please like and subscribe.